Good afternoon, guys. So, what we just saw today was a mega hyperscaler rally. We saw companies like Oracle up 9%, Microsoft, Google, Amazon all up 4.5%. And so the Mag 7 has sort of been, it typically has been like the best performing asset class, but in 2026, it's been left behind. Well, the earnings keep coming out and they're very good. So, not only are these companies growing their core businesses and making a lot of money for shareholders in the GAAP EPS. But what we're also seeing is that their investments are doing incredibly well. Google owning 10% of SpaceX and just marking that up creates huge GAAP EPS growth. We saw that 80% of Amazon's GAAP EPS profits came from Anthropic this last year, or in this last quarter, as they marked up their Anthropic stake. Amazon owns 15 to 20% of Anthropic. So these companies aren't really just the tech businesses they are, but they've also become investment funds of their own. And it turns out that they're making really good investments. They're able to leverage their scales, somebody like Amazon, and say, hey, Anthropic, in addition to helping you with your cloud compute, let us invest in you. They get unparalleled insight into businesses that are growing well and providing a lot of value to their customers. And then what they're able to do is make crucial investments in these companies at opportune times. So they really are an investor with large edge, and they've turned into really a new form of wealth that we haven't seen in companies for a long time. So that's great. This rally also saw Reddit bounce back. It saw Meta, bounce back from its sell-off. So I think we're seeing some resilience in the market. We saw that hedge fund guy, Leopold Blowout, and that was an interesting blowout, really, because what this guy was doing, if you looked at the portfolio and the holdings, is that like 90% of the names didn't make any money. So they were all unprofitable. And he was buying these companies like T1 or TE is the ticker. These are small cap companies with very illiquid stocks. And he was buying these companies for 4x leverage, supposedly. And I can just tell you, being an experienced trader, working as a market maker in the past, that if you're buying a company like that, and you think that you can sell billion-dollar positions to fund margin calls. So as the stock starts turning around, you have to sell your public securities to fund the margin calls. Well, we saw we saw TE like dropping back to back 20% days, and we know now that it was Leopold and his prime brokers selling their exposure to that stock to fund margin calls. There's no liquidity in companies like that. Like you can't offload those shares. You'd push the price all the way to zero, which is why Leopold was forced to sell it to his whole public equities book to Citadel at a 10% markdown to the net asset value, which is just enormous for when you talk about a portfolio that it's a leveraged portfolio. So it very well might have been worth $50 billion once you include the leverage. So taking a 10% markdown on that is $5 billion, and you would only do it if you were absolutely desperate and thought it was the only way out. So that was an interesting blow up. We've seen a lot of those names actually bounce back, but the interesting thing is it seems like this guy was pouring money into these small companies. A lot of the share price appreciation likely was simply just that he was pushing the price of the stocks up by buying so much. And we saw this in ARKK in 2022, or ARK Invest. And you have to wonder, when you're using that much money to invest in illiquid like small cap securities, how much of it is potentially just market manipulation and not actually good investing? Myself, I focus on highly profitable large cap businesses. So pretty much the exact opposite of what that guy does. I don't use any leverage at all in the business or in the investment funds I run. And I think that that's a safer way to invest. If you would use leverage and you invest in highly volatile securities, you basically guarantee that your fund will blow out in the long run. And blowout is like suffering a catastrophic loss. It's hard to make up from it. And so, I know that some people say that his fund is up year to date or whatever, but you really don't know when the money flowed in. All the money might have flowed in after the large rally. So he actually might be a net loser for investors. But now the leverage is off the books, right? And if he had 45 billion at the peak in his fund, he was 4x leveraged. He could have been buying with leverage $150 billion of stocks in illiquid small cap companies. So it's easy to see how he could have been moving market prices up. And then when he sells, wow, look at, they all tanked. I mean, I looked at his portfolio, almost all of them were like minus 50% on the 1 month. And my July month was not bad at all. So it's like, it wasn't green, but it was like really not a bad month at all. So I just find all that was very interesting. So yeah, it's been good, you guys. A little background: I'm John Tinsman. I run the AOTG ETF here out of Bettendorf, Iowa. So if you guys like this content, like and subscribe. So thank you, guys.